When most people think about global investing, they actually think mostly about the US. The S&P 500, for example, the Apple stock, Microsoft, Nvidia. These companies define not just markets, but the way we live and work. Europe, for years it was ignored, and Asia considered risky, unstable, and political. But now in 2025, the landscape looks a little bit different. The US valuations are very stretched, and Europe is rallying, while Asia, though volatile, offers very interesting long-term growth. So I think we should dive deep about whether or not European stocks are finally more interesting than US stocks, and where maybe Asia is fitting in the global equation. So let us start with the US dominance and fragility. There is no denying in the dominance of the US market. The S&P 500 makes up over 70% of the MSCI World Index. In other words, if you invest passively in the so-called world market, you're overwhelmingly betting on the US. And this dominance rests on innovation, more specifically on tech innovation. Apple, Microsoft, Nvidia, Amazon, Alphabet, together they represent more than an entire quarter of the entire US market. And that concentration is both a strength and a weakness. In the US market, especially the valuations are very expensive. The forward PE ratio is around 22 to 23, well above the historical average. By comparison with Europe, Europe is trading closer to 16, while the Asian stock market is even lower. And the US also has another issue with debt. The US government interest payments now exceed the entire military spending, a signal of financial imbalance. And also politically, the risks are rising. Earlier this year, the sweeping tariffs on the Liberation Day triggered a 6% market crash in one single day, followed by a 9% rebound when policies were rolled back. And this volatility shows how dependent the market is on politics as well as profits. Yet, despite these risks, the US continues to attract capital. But why? Because it's structurally, it is the most liberal capital market in the world. Flexible labor laws, deep financial markets, entrepreneurial culture, a free flow of capital. Over the last century, these traits have allowed the US equities to outperform nearly every other region. And investors obviously know this, which is why the US keeps its premium. Because if you buy the stock market of a country or area, you are also investing in the philosophy, in the capital philosophy of this region. So let's look at Europe. Europe, by contrast, was long dismissed. It had slow growth, political fragmentation, a lot of bureaucracy. But 2025 has been different for Europe. The msci Europe index rose about 25% this year so far, compared with just 6% for the S&P 500. But why? Because of the valuation and politic. This Euro Stoxx 600 trades around 16 forward earnings, far cheaper than the US. The dividend yields average 3 to 4% in Europe, which is about more than double of most US payouts. And then add in a euro currency that has strengthened by about 14% against the dollar this year, the returns will look even better, especially for US investors buying European stocks. The institutional money is moving a little bit in 2025, especially with sovereign wealth funds like the New Zealand Super Fund that are tilting overweight in Europe and underweight the US, precisely because of this huge valuation gap. Goldman Sachs estimates the European equities still have around 6% upside into year end. For decades, Europe was priced as the second best below the US stock market. But today, that discount is somewhat of an opportunity. And the key question is if this is a short-term rebound or the beginning of a structural shift. We cannot ignore the weaknesses of Europe. Europe's demographics are poor. We have an aging population and slow consumer growth. The politics are messy. There's a lot of fiscal disputes, populist movements, and also limited military strength. The labor markets are less flexible and very strict comparing with the US or Asia. And this all is making the scaling for Europe a little bit more difficult. But the weaknesses are also baked into the valuations of the European stocks. Unlike the US, which often prices in optimism, the European prices are often a little bit more pessimistic. And when reforms happen, like the Germany relaxing its fiscal constraints or the Brussels cutting the red tape, the upside surprises can be much more greater than in America, which are already very optimistic about the future. And structurally, the European companies tend to be more conservative than the US stocks. European stocks mostly have less debt and more dividend payouts, and also a global exposure and positioning beyond Europe. They may not be the fastest grower like US stocks, but they're often the more disciplined. And in a high interest, fast changing world, that discipline can also have a lot of value. And then additionally, there is Asia, of course, the kind of wild card. China's CSI 300 index is up about 14% this year, helped by domestic stimulus by the Chinese government. Yet the foreign sentiment about Chinese or Asian stocks is still a little bit cautious, with concerns over real estate, debt, and geopolitics. This creates a very deep undervaluation. Many Chinese and Hong Kong listed stocks trade at single-digit PE ratios. For contrarian investors, that can be very tempting. India, meanwhile, is the opposite story. It is quite expensive, but growing very quickly too. With a GDP growth over 6%, a very young population, and major infrastructure spending, it may follow the US path of innovation and capital growth. Southeast Asia is also benefiting from the supply chains diversification as companies shift operations away from China as a result of the tariffs of America. Asia is not for the faint of heart, definitely, but historically, these regions most feared often produce the most and greatest opportunities for patient investors. The question is whether you see today's risks as a trap or tomorrow's discount. So where does this all leave us? If you hold the msci world, you're already heavily invested in the US, whether you like it or not. That means adding European equities isn't about replacing America. It's about balancing your portfolio with value and dividends. The US remains the innovation engine, supported by a very capitalistic culture that rewards investments. Europe is the undervalued stabilization with cash flows and global champions. And Asia can be the long-term option, risky, but potentially very transformative. So the lesson is, stop thinking in binaries. Don't ask US or Europe. The real question is, how do you combine innovation, capitalism, liberalism, value, politics, and growth into one resilient global portfolio? So are European stocks more interesting than US stocks in 2025? Right now, definitely yes. They are cheaper, more stable, and benefiting from reforms and currency strength. But history shows that the US, with its liberal and capitalistic structures, remains the long-term growth leader. The wisest investors won't choose sides. They will hold the US for innovation and growth. Europe for value and income, and maybe Asia for very risky growth. That combination creates resilience, opportunity, and balance. So now it's your turn. Would you shift capital into Europe today or stick with America's growth story? And are you willing to take on Asia's volatility for the chance of long-term growth? Let me know in the comments, and thank you for watching.